Welcome. Please like this video and subscribe to my channel for more reverse mortgage content. We're going to get started right away. Now, why would you do a reverse mortgage on a free and clear home? A home that doesn't have a mortgage? Well, let's see. We're going to go over the example, get into the real details of the loan here. Betty Boop is age 67 and she owns her home free and clear, meaning she has no mortgage on her home, and it's worth $800,000. Well, Betty Boop was at tea with her friends, and one of her friends suggested that she'd take out a reverse mortgage on her home because interest rates were higher now. Counterintuitive, right? We're going to see why she said that. And Betty leapt up, all offended, and screamed at her friend, "Why the heck would I get a reverse mortgage?" Let's take a look at why her friend might have suggested that. Before we do, I am Christina Harms Heika. I am a certified reverse mortgage professional. There's only about 200 of us in the country. It's the highest designation in reverse. I'm going to go into an actual loan and all the details, so stick with me. You're going to understand how this whole thing works and why you might want a reverse mortgage in a high interest rate environment with a free and clear home, a home that has no mortgage on it. Why you might do that. This is my information. Should you want to contact me, please feel free. I coach loan officers too. If you're a loan officer, give me a call. If you're a client and looking to do a reverse mortgage for you or a friend or family, please give me a call. I'd love the chance to walk you through this. Let's dive right in. Okay, so why would she want to do a reverse mortgage? Well, because today's reverse mortgage has this gigantic magical feature called a line of credit. And some of you may have heard of a home equity line of credit, which gives you access to your home's equity that you can draw on it when you need it. A regular home equity line of credit is not a good fit for retirement because it closes after 10 years and then you have to pay the whole thing back. And you have payments the whole time. So a reverse mortgage line of credit is magical for retired age people because if you take this thing out at 67, like Betty's going to, at 77, she's no more likely to have a higher income to pay back a large amount, and the reverse mortgage line of credit doesn't close. So this thing can be open the entire time she has the mortgage, and it grows, which gives her increased access to her equity over time. What? The theory is that your home's going to appreciate anyways, or Betty's home is going to appreciate anyways. They don't want people to have to refinance their reverse mortgages regularly in order to get access to that equity. So you qualify one time. We check your credit, we check your income, you qualify this one time, and then you have access to your equity in a line of credit, and it grows. It is a huge safety net. It provides for people to be able to age in place, fix new roofs, get new cars, pay huge medical debts, bring in in-home care. Whatever it might be, this is your equity. There's no limit on how you use the funds. Let's go into the actual numbers so you can understand an example of how the reverse mortgage itself works, the costs and the fees, how it'll work for Betty Boop now, how it'll work through her retirement, and what happens at the end. Excuse me, my nose itched. All right, so this is the graph, and you can see here, right? This is just a really high-level overview. She's going to start with a line of credit. I don't know the exact number yet. We're going to get to that, but somewhere worth a portion of her home's value. And that line of credit will grow. This is why her friend said, set this up now. And because interest rates are high right now, high compared to what they were 2 or 3 years ago, the growth rate, we can't call it interest, it's not actually interest on this line of credit, it's just a growth rate giving you increased access to your equity. It grows really, really beautifully. It grows better now at a higher level of interest rates because that growth factor is tied to interest rates. It grows so well right now. So let's take a look. I'm going to dive straight into the numbers. Now, this is an example on Betty Boop in Oceanside, California. This is where I live. And just to give you another example of the graph. So this shows you the balance of the mortgage. So many people think, oh, I do a reverse mortgage, I'm not going to have equity in my home. Not true, especially in a market like Oceanside, California, especially if she doesn't use those funds right away. here's what the actual balance of the mortgage will do. It's super, super low to begin with, and it stays pretty low. Assuming she doesn't use that money, that line of credit will grow, and then it's there for her in a large amount when she does want or need it. Now, here is the equity in the property. Lots and lots of equity, way above this balance line, right? And then the property value, really, really high. The line of credit gives access to this equity, and you only have to set it up once. And it's really important you set it up while you are still having good income and good credit. So many people wait to do a reverse mortgage until they had some sort of life event that causes their credit to be bad, and then they can't qualify. Or they try to delay the reverse mortgage, they do another type of mortgage, and then they don't have enough equity to do it. So do this early in retirement to set this up, to set yourself up for retirement. Let's go straight into it. Now, this is the master number of reverse mortgages. So I'm going to zoom in here so you can see the page. So as you can see here, Betty Boop, we've got her date of birth. Every reverse mortgage number is specific to the youngest borrower or non-borrowing spouse's date of birth and the property value as well as current interest rates. So I want to go over an example. We're looking at the FHA HECM, Home Equity Conversion Mortgage. Now, this is an FHA insured type of mortgage. Now, this isn't actually an adjustable rate type of mortgage. About 98% of all reverse mortgages done today are adjustable rate types of mortgages. Oh, but Christina, aren't adjustable rates terrible? Nah. I've been in mortgages for a long time. I used to do the forward kind of mortgages, the regular kinds. And I will say that adjustable rate mortgages got a bad rap in the crash, right? 2007, 2008, 2009. And whether it was founded or not, I don't know, but I never really did adjustable rate mortgages on the forward kind, the kind that have a payment. This is what happened. People got adjustable rate mortgages, the kind that had a payment attached. And when that rate adjusted up, the payment also adjusted up. And this was at a time when people were losing their jobs. They didn't have more money coming in as they either expected to, or maybe they didn't really understand what they got. Don't know. In any case, adjustable rate mortgages, the kind with a payment attached, yeah, I'm not the biggest fan of. But adjustable rate mortgages for reverse mortgages is so different because there is no payment attached. It also creates a lot more flexibility and you can access more funds. So we'll see that. I'm going to compare to a fixed rate type of reverse mortgage, which of course you can do. And I always tell my clients, I'm just here to educate you. So whether you decide on the adjustable or the fixed rate, once you understand how it all works, that's up to you. But it's my job to say, okay, if I were in your shoes, this is likely what I would do, and here's why. And a lot of the time, that is the adjustable rate. In this case, you only have access to a line of credit if you do an adjustable rate. And when there's a free and clear property, unless you have some immediate need for cash now in a lump sum format, there's no reason to borrow that money and incur interest on it from day one. There's just no reason. There's no justification, in my opinion. So we set up a line of credit so that you are protecting yourself for the future and you're not incurring any extra interest on money you don't want or need right now. So we use an index. Any adjustable rate mortgage is on an index, and that index is called the Constant Maturity Treasury, CMT. And the product that I like the best, the loan option, is called a monthly cap 5. Now that means the rate adjusts monthly and it is capped at 5 points above where we begin. Now keep in mind, these interest rates are just hypothetical examples and they're based on today's interest rates. Interest rates change regularly. So don't get attached to the outcome numbers because the outcome numbers I'm about to show you are just a hypothetical example. And if and when you look into a reverse mortgage for yourself, at a different point in time, if interest rates are higher or lower, the numbers will all change. Also, different home value, different date of birth, that's going to affect it too. All right, so we have the index here. It is based on the 1-year constant maturity treasury. And then we add a margin onto the index, and that margin is 2.5. That takes us to the initial rate. That initial rate right now for Betty Boop would be 7.62. Now, Christina, why is there a second rate here? What are you talking about? It is kind of weird. I'll give you that. In reverse mortgage world, we use what we call the expected rate. And what this is, it's based on the 10-year constant maturity treasury. And so what this is showing is that over the next 10 years, Betty Boop can expect her interest rate to actually average 6.82, which is a unique point in time. In my other videos at other points in time, you may have seen the expected rate to be higher. But right now, we're actually expecting rates over the next 10 years on this index, the constant maturity treasury, to come down. And so that's the benefit of a adjustable rate mortgage as well when we're expecting rates to come down, is that the rate will naturally come down with it. Now, if rates do go up, it will go up with it, but we have a cap on there. Let's go over that. There's an interest rate cap. The highest Betty Boop's interest rate could ever go, if we were to lock this loan in today for her, is 12.62. So that is 5 points above where we start. So you got 7.62, add 5 to that, you get to 12. So the highest interest rate Betty Boop could ever get to is 12.62. Even if we saw interest rates revisit what we saw in like the 80s, where they get to 18, 20%, some of you guys remember those days, where this mortgage will never get that high. It will be capped and it will stop at 12.62. Now, if the interest rates go down, the lowest it could ever go is the margin. So we've seen that too. Back in 2019, I reviewed a few clients' statements for their reverse mortgage, and their interest rate was pretty much as low as the margin. And I said, you know what? This is a great loan. We're not going to change anything for you. So that is a possibility too. It's rare that it happens, but we just saw it a few years ago, so I do want to mention it. MIP, Mortgage Insurance Premium. Mortgage insurance with regular mortgages typically protect the lender only, in my opinion. Mortgage insurance on the reverse mortgage, though, has expanded protections for the borrower. And it's the only way the program can exist without astronomically high interest rates. Now, there are private reverse mortgages or proprietary or jumbo reverse mortgages, and they do have those higher interest rates to make up for not having mortgage insurance. In my opinion, if you qualify for an FHA HECM, because of the lower interest rates provided for by the mortgage insurance, it is most of the time a best interest of you and your heirs to do an FHA HECM. Now, there are situations where this is not the right fit, and I have done many of those loans. I do a lot of jumbo loans. But if the person can qualify for an FHA HECM and the numbers can work to fit their goals, wants, and needs, I honestly prefer that they do this because it's just a little bit safer to have the lower interest rates here. Let's go over what this mortgage insurance protects for. First, this is a non-recourse loan. So Betty Boop and her estate and her heirs will be protected in the case that 2007, 2008, 2009 happens again, where the market value plummets. This is a non-recourse loan. And what that means is that the lender can only look to the value of the property for repayment of the loan. They cannot look to the heirs. They cannot look to the estate. Reverse mortgage doesn't even show up on your credit report. Can you believe that? And through the closing process, you will sign a few times saying, I understand this is not a personal liability. Now, you are still the homeowner and you are the borrower, so you do have some responsibilities, but it's not a normal mortgage that would show up on your credit report. Second, this line of credit is so unique and it was designed for retirement age. The reverse mortgage is a very young type of mortgage, which is part of the reason why there's so many misconceptions, and we had a bumpy start to begin with. We did. I will tell you that. We used to lend way too much money and people would use it way too fast. There's some protections built in because of that. And we didn't used to protect non-borrowing spouses. If you had a spouse that was too young, they weren't protected well. All of that has been fixed. Reverse mortgages today are a very good product for a lot more people than people think. Now, I will say there are certain situations where reverse mortgage is not a fit. So make sure that you're working with a loan officer, hopefully me, I'd love to work with you, that understands that this is a fit, this isn't a fit, really understands your goals, wants, needs, and sensitivities. back to the mortgage insurance, what it provides for, that line of credit. Nowhere else are you going to be able to find a home equity line of credit. Now, this is I call it a RELOC, a reverse equity line of credit. Nowhere else are you going to find a line of credit attached to the home to give you access to your equity that does not close after 10 years. So a HELOC that you can get like through a bank, I call those fast, cheap, and easy. And they're pretty costly at the end. So anything fast, cheap, and easy is typically not a great fit for a holistic, really good plan. This is not fast, cheap, or easy. We'll get into that in a minute, but there's huge benefits. The line of credit never closes. So let's say if you get this, if Betty Boop gets this at 67, she is no more able to pay back what she's borrowed at age 77. People's income in retirement is typically fixed. And there's lots of life events. We have clients who've experienced falls, medical diagnosis, adult children that need help, adult grandchildren that need help, new cars, home repairs, like a roof leak. These things are costly, a new water heater, stuff like that the line of credit is there to access. And especially for the home repairs, let the home pay for those repairs, my goodness, because especially if you want to stay in your home for the rest of your life, which I think it's something like 67% of baby boomers do want to do that. If you're one of those people and want to stay in the home the rest of your life, let the home pay for its own repairs. You're not adding equity to then experience the benefit by selling it at some point. So that's one just personal preference. But the line of credit is available the whole time you have this mortgage. And I say it that way because I won't say as long as you live, because some people will not live in their home all the way till they pass away. Some will sell, and you can. There's no prepayment penalties. You are the owner on title. Big misconception, you're not selling your home to any bank or anything. It's just a mortgage, which is a lien on title. The difference is you don't have to make monthly mortgage payments. And the difference is because you don't physically send in your hard-earned cash every single month, the interest is just added to the loan balance. So a regular mortgage goes down a little bit every month. You've probably experienced that. It's painfully slow. A reverse mortgage is the opposite. It goes up a little bit every month. And typically people don't keep these more than about 7 years. That's the average time people have a reverse mortgage, mostly based on life expectancy. All right, let's keep going. This line of credit cannot be frozen simply due to the market going down. So again, let's revisit 2008, 2009 during the crash. This was a time when people were losing their jobs. They needed access to funds. They thought they had set up a line of credit that they would have access to. But when the real estate market values drop, all those HELOC providers send letters out to their customers saying, hey, your line of credit is frozen. You can no longer pay. You can no longer draw any funds from it. No matter how much was available. This didn't matter. But hey, keep making that payment. It was a terrible catastrophe, and people were really shocked. They didn't know that that could happen. I'm here to tell you that can happen. Not on a reverse mortgage line of credit, though. This mortgage insurance that you're paying for, I want to say it that way because when I cover this topic and I don't remind people they're paying for that benefit, they go, this is too good to be true. It's not. You're paying for it. You are paying for the benefit of having that line of credit open and available to you for your entire retirement, for the rest of your life possibly, but for as long as you keep this loan and you comply with the terms. Let's go over that now before we move on. What do you have to do to comply with the terms? Number one, you must pay your taxes and insurance. I mean, property taxes. Hopefully you're paying other types of taxes too, but for this purpose, I'm talking about property taxes on the home. You must maintain those. Please make sure you're paying them on time. Any HOA or other property charges. Sometimes we'll see people with like flood insurance and your HOA payment. That's not included. The only thing we're taking away is a mortgage payment. You do not have to pay principal or interest towards this, though you can, should you want to. We're going to get into that in a minute. You have to live in the home as your primary residence. This is only meant for primary residences, which means you need to live in the home for 6 months plus 1 day of every year. It doesn't mean you can't have a second home, but it does mean that you want to keep your primary residence and all of your mail and your driver's license and all of your stuff coming to this primary residence, and of course, live in it. You must, the mortgage is due back if you were to sell. You can sell at any time. You are the owner on title. There's no prepayment penalties. Just like any other mortgage, when you sell the home, you simply pay off the mortgage and then you keep the rest of the equity. Same thing here. And then if you don't maintain the home, because the home is the collateral for the reverse mortgage, it's really important you're maintaining it. Now, these items are pretty simple. It's to FHA health and safety standards. So if the heater goes out, you're fixing it. If there's a broken window, you're fixing it. If you have a pool, you're keeping it maintained and filled. That can be a hazard, actually. I've informed some clients who had an empty pool, hey, somebody could fall in there, something could fall in there, and that's a hazard. So you want to keep that pool maintained. If a stair breaks, if a handrail breaks, maintaining the home's paint so termites and insects don't go in. The most common story that I hear about this maintenance requirement is if a home is in such disrepair, a neighbor calls and the home is condemned. In that case, the reverse mortgage is due. So those are the important requirements of the reverse mortgage. Any one of those things can freeze the line of credit. So you want to make sure that you are doing those things so that your line of credit is always available to you. And now the line of credit can actually help you pay the taxes and insurance too. I have clients who set it up for that exact reason, especially in states where property taxes are not capped. Betty Boop luckily lives in Oceanside, California. California has Prop 13, which keeps our property taxes low. But even if she didn't, you'll see in a minute, the numbers look beautiful for her to be able to draw whatever funds she needs to pay taxes or whatever else she might need. Now, if you have credit or income qualification problems, there is something called a life expectancy set aside. This video is not to go over that. That is a whole video on its own. But just know that if you have credit and income challenges, it's really important that you work with a certified reverse mortgage professional like myself and my team, and that there is a provision to help make sure you can get one of these within reason. There are certain people that we just can't help. And if that's the case, then you do probably likely need to sell, get the equity out, and go buy somewhere else. You can buy with a reverse purchase, possibly. Another video for another day. All right, this mortgage insurance, it also protects the heirs. This is a non-recourse loan, no matter what may happen. If for whatever reason the market value of the property were to be below the loan balance at the time that you or any other borrowers or non-borrowing spouses pass, the heirs can mail in the keys. They can still choose their own realtor, sell the property, and send in what they get. And or there's a really cool provision. It's a 95% provision. There's another video I need to make about that, but it allows heirs to purchase the property back for 95% of the current market value. The FHA insurance is picking up any difference. So it's a really, really cool thing. It's very protective, especially if you think, prices are high and they might go down in the future. Get your reverse mortgage based on these high values today. The initial line of credit growth rate. This is a growth rate. I often hear loan officers, and I encourage them to come coach with me, and they'll say, oh, you're earning interest. You're not earning interest. You are not earning interest in this line of credit. You are simply getting increased access to your home's equity. Now, that rate is 8.12, and we get there by taking the initial rate plus the mortgage insurance, and that gets us to the line of credit growth rate. And yes, it will go up and down as this initial rate goes up and down with the market. So this is why Betty Boop's friend said, hey, it's a good time to get a reverse mortgage, especially if you have a free and clear house with no mortgage on it, because one, your line of credit is going to be huge. We're going to see that in a minute. And two, that line of credit is going to grow at a really fast rate. So you're going to get this huge increase in equity access. An analogy I like to use, think of your credit card. Maybe you have a Capital One credit card. There's a million credit card companies. I'm not sponsored by any of them. But just think of a credit card. Let's say you've got a $10,000 limit on that credit card. So you can borrow up to $10,000. And let's say you've had this credit card for years and you've been a good customer. So you call and say, you know what, I'd really like my credit limit to be increased. And hopefully they type on their computer and they say, yeah, you're right. We should increase your credit line. Congratulations, your new credit limit is $15,000. We've expanded it from $10,000. That's the same concept going on here. This, except it's built in naturally. You don't have to call anybody. You don't have to ask for it. It is built in because they assume your property will appreciate. Properties always have. They assume you will be getting older and may need access to more of your equity in the future. And they do not want people to have to refinance in order to get that. It's really a cool feature that you can qualify for this once and get this increased access. And I say it that way because sometimes I have clients who wait until they've used up all of their other assets and now they have credit problems and now they're like, okay, I'll do the reverse mortgage now. And I can't qualify them because they don't have enough equity in a lot of cases. They've tried other types of mortgages and really put themselves in a bad situation. Set this up once, especially if you're about to retire. Qualify on your working income, please, and qualify before you have any credit damages. Another tip, pay your property taxes and homeowners insurance on time religiously. If you think a reverse mortgage might be for you, pay all of your debts on time. It makes my life a lot easier, makes your life qualifying a lot easier. All right, let's go into this. So right now, with every reverse mortgage, we estimate the home's value. I've gone on Zillow and said, hey, Betty Boop, you've told me you think your home is worth $800,000. I've gone online to some automated valuation systems like Zillow and Redfin and Trulia and those things. And I verified $800,000 seems about accurate. So we're going to go in with this estimate. Through the reverse mortgage process, an appraisal will be ordered. Don't order that yourself. We have to order it tied to the loan number and the FHA case number. So we'll order that. And through the process, we'll get that appraised value. When that appraised value comes in, this number will be updated. If it's higher, all the figures that follow that we're going to talk about will go up. If the number is lower, all the figures that follow will go down. So keep that in mind. That's the normal process. Hot tip. About 1 in 4 reverse mortgages, FHA type of reverse mortgages, require a second appraisal. Now, when that happens, it's not up for discussion. There's no way around it. You have to order a second appraisal. So there's typically the cost of a second appraisal. And then we have to use the lower of the two values. So my advice is be really nice to your appraiser. All right, principal limit. It's a little bit random too. People always go, how do I avoid that? And I joke and say, be nice to your appraiser. It's pretty random. It's like 1 in 4. So if you're in that boat, just unfortunately, you just got to kind of grit and bear it. And when that second appraisal comes in, if it's higher, people get excited, but unfortunately, we have to use the lower of the two. Sometimes it's lower and it lowers the numbers. The principal limit. I wish we had a different name for this. What I like to say is you can think of this as the amount the lender is willing to lend. And this is the number that is very custom and specific to every single reverse mortgage situation. So I'm doing an example here. Now, the variables that are really important, some people are like shopaholics and they like to shop reverse mortgage quotes. It's really important if you're doing that you tell the loan officer you're working with or multiples that you are the exact date of birth of the youngest borrower or non-borrowing spouse, the property value you want them to use, and you want to get those quotes really close in proximity because rates change regularly. So if you can get all those quotes on the same day, then you can compare apples to apples. But different points in time produce a different principal limit, and that's how much you can borrow. Now, people are often shocked too, so you're seeing it here first. You can't borrow that much. She's only 67. If Betty Boop was 97, this number would be a lot higher. If interest rates were lower, it would be a lot higher. So those two factors do play a part. If you've been kind of dabbling about your reverse mortgage and I don't know, should I wait, should I do it? And you hear that interest rates drop, do your reverse mortgage. But don't wait till property values go down because that makes the biggest difference. So if If this 800,000 turned into 600,000, oof, that principal limit, imagine how much that would go down, because it's a percentage based on that. All right, let's keep going. So now we're getting into the costs. Here is the second type of mortgage insurance. The first type is that 0.5, and it's just added to the loan amount every year. It's an annual amount. This second type is a one-time upfront fee, and it is a formula FHA mandates on all FHA HECMs. Right now, they do change it sometimes, but we don't have any predictions for changes on this right now. It is simply 2% of the home's value. Not going to get into the max claim number detail here, but know that right now, if your home is worth more than 1.49825, yes, I'm using my sticky note on my monitor to tell you that. If it's worth that, you will be up against that limit, and there's some complications. So if that's your case, please call me. I'll explain the details of it. I may do another video on it, but at this moment, I don't have one. For most people, though, you're going to be dealing with just simply 2% of the home's value. And so when the appraisal comes in, if it's higher, this number will go up. If it's lower, this number will go down. And this is not an out-of-pocket expense. This is simply financed into the loan amount. And then we have an origination fee. I try to go as low as I can. Now, on a property that is free and clear, we can't go that low on the originations typically. The max is $6,000 currently. So you want to look for something less than $6,000, and no, most loan officers can't go that much lower than that on this particular situation. Other situations have different setups. And I'm a broker, so fully disclosing, I am a broker, and that I have relationships with all the different reverse mortgage lenders, and it is my job to help facilitate the loan, and that's payment for placement of it and facilitation. Other fees. So these are similar to what you'll find on any type of mortgage refinance. And most of these are all third-party fees to get the loan done. So in order to do a reverse mortgage, like any mortgage, we need to run a credit report. You'll have to attend a third-party HUD-approved counseling session. And that counseling session should go over everything your loan officer already explained to you. If you're learning things in your counseling session, you need a new loan officer. Other fees, appraisal, government recording charges to record this new mortgage, a notary to come to your home, or maybe you're going to an escrow office to sign your closing documents, an escrow company, a title company, all these have fees. This is the summary of that. Now, these 3 lines are the summary of the fees to put the reverse mortgage in place. Most of them are financed in, with the exception of a few. And different lenders have different ways of handling these fees. I will tell you the way that I handle them and how most brokers handle them. First, the cost of counseling. Now, this is FHA mandated, so you cannot have a loan officer paying for your counseling session. If you do, get a new loan officer because it's not legal. Counseling session. Everybody who does a reverse mortgage has to go through a third-party HUD-approved counseling session. Typically, these are over the phone. There's some states that require face-to-face, but not many. So it's about an hour, and by the end of that session, you should have a complete understanding of the reverse mortgage. Ideally, they're just telling you everything the loan officer already did, and they're answering questions. They're asking you questions too, right? What do you have to do? Pay taxes, pay insurance, pay HOA, live in the property, maintain the property, all of those things that to make sure you have a clear understanding. That was a protection built in. When reverse mortgages first started, they didn't have that. And they said, you know what, let's add this in to make sure that people are really wanting to do this and they really understand. Because as you can see already, there's some differences here, and it's a different kind of loan. We need to make sure you're educated and fully informed before you make decisions to move forward. Cost of counseling should be anywhere between $150 and $300. Your loan officer will provide a list of counselors. If they haven't, get a new loan officer. I hate saying that, but unfortunately, any loan officer can typically do a reverse mortgage. There's no extra licensing required. However, as you can see right now, there's a lot of weird details about these things. The process to do them is also different. And you need to know what you're doing to guide, well, the loan officer needs to know what they're doing to guide you, the client, through the process. And there's a lot of loan officers who don't realize how different it is. And it's honestly the biggest asset most people have. So I take it with a huge, huge honor that I am in the position to help, and high regard for the competency needed. And you should too. Other fees. So the cost of counseling, cost of one credit report. Right now they're running like 70 to 100. The cost of one appraisal, possibly two if you are in that boat. Appraisals 500 to 1,000. If your property's in the millions, you're probably looking at a jumbo video, and I haven't done one of those yet, but I may in the future. You're probably looking at a jumbo reverse mortgage. I need to do a video on that. And those appraisals can be higher. I had a $15 million property one time, and that appraisal was $1,400 just because it was huge. It was a very unique property in California. So just know that. And there could be a second. Other than that, so those total fees should be around 1,000 or less total. Other than that, the rest of these fees are financed into the loan amount to be paid back when the home sells, or you move out, or you pass away, or fail to comply with the payments and the maintenance. So after these fees are financed in, what's left? $264,000. Now, FHA, a few years ago, this is one of the black eyes on the industry, in my opinion, where people used to get access to these reverse mortgages, and they would get access to a lot of money. We used to have much larger principal limits. So, instead of $289, we'd be looking at like $489 or $500, something too big, and people would not handle that well. So they would use their equity way too fast. So they did a few things. They lowered how much we can use, and they added in this first year provision. What this is saying is that within the first year, you can access up to $148,000 of the $264. After the first year, the rest becomes available. Now, some people are pretty shocked at this, going, wait, I thought reverse mortgages paid you every month. And yes, that is an option. Reverse mortgages are super customizable. So you want to make sure your loan officer understands your goals, wants, needs, and sensitivities. Because let's say you're just short every month and you need a little more money every month. Well, in that case, you may want to set up a monthly payment to you. And in that case, for Betty Boop, she could, instead of doing this line of credit for $264, she could do a 10-year payment, which are equal monthly payments deposited to the bank account of her choosing every month on the same day for as long as she keeps this reverse mortgage, even if that's like, even if she lives to like 110, 115, these payments will still come in. So I like that format for people who have longevity in their family to protect against the cost of living going up. Because with a line of credit, if you draw it down to zero, it doesn't come back. And people can and have. With the 10-year payment, though, that payment will continue to go in. So there's a possibility, if you live long enough, you could actually experience getting more money overall. It's not a fit for everyone. We're going to see why the line of credit is really powerful for Betty Boop in her situation. But if Betty Boop's parents both live to like 105, 106, and she goes, yeah, I'm probably going to do that, I might be suggesting the 10-year payment or a mix and match. Again, a competent loan officer will be able to educate you that we can mix and match this stuff. So Betty Boop could come back and say, you know what, Christina, I do want a 10-year payment, but I don't want that much, and I still like to have some in a line of credit. Why don't we do a regular monthly payment to me for $900 and leave the rest on a line of credit? And what I would do, I'll just show you this real time. Ooh, you guys are getting the good stuff. All right, I'll show you this real time. And for you loan officers who are watching this, watch how to do this. Okay, so Betty Boop just told me, hey, I really want a $900 monthly payment and leave the rest on a line of credit. I've typed this in, I haven't hit enter yet. You can see the line of credit right here is $264. But let's say, okay, for life, she wants a $900 payment. How can we break up this pie to do that? And hit enter. And now you can see this is a protective way to do these loans too. Now Betty Boop can get $900 a month for as long as she keeps this reverse mortgage and a line of credit for $130. We can do any number up to that 177 number, whatever it was. And if we did, it just keeps changing the line of credit. It is a pie. We're just cutting it up different ways. All right. But Betty Boop doesn't want a monthly payment. And she doesn't want cash now. That's another thing that I need to tell you. You can get lump sum at closing of the loan. And that, you know, if you have a roof that needs repaired, if you have any need for cash, like that's a common example, but any need for cash now, you can get cash now too, up to the first year amount. Some people will draw that for full first year amount in the first year, but it's important you know you don't have to. The sloppiest quotes I ever see, I won't name any companies, but there's some companies that do it regularly. The sloppiest quotes I ever see, they do the full draw within the first year. Often, that person will be redirected to me, and I'll see the quote and go, okay, what are you using all 148 cash for? And they go, well, I don't know. That's just what they said I could do. I said, okay, why are you going to incur interest from day one on $148,000 if you don't want it or need it? You go, I don't know. Me neither. So let's not do it. Get a new loan officer. All right. So I will stop with that and just go to the line of credit. We're going to set it up for 264. We're going to assume that she is setting this up without any need or want for cash now and no regular monthly payments. Her initial loan amount is simply going to be the fees. So to put this in place, the fees are about $25,000. Now people often go, oh, that's too expensive. And I have to ask, what did you buy your home for? What is it worth today? And if the market dropped 1% next year, how much would it be worth next year? Do you think $25,000 is worth putting this in place now at this higher value? Typically, yes. Yes, it is, because this is just equity in the home that can disappear with the market crash or a market downturn. It doesn't have to be a full crash, right? We've all seen our homes go up in value and come down in value. Now, we're at a time where homes are high in value. So please, please, please put this into perspective. You're setting up something that can protect you for the rest of your life. Now, before we move on to the next page, which is really important, so stick with me, I want to show you that fixed rate option. Every now and then a fixed rate is a right fit for people. Now, legally, I have to disclose this middle option. I will tell you I've never done one. I won't ever do one because it is the same loan that we just went over with the exception of the cap rate. It's double. To me, it's just not so safe. Why would you do a double cap rate? Now, some people will say, well, because her line of credit, you know, it's big and it could grow. Maybe, but in my world, I've seen a lot of borrowers borrow that money and then they are incurring interest. So I want to be protective. I never do that loan, but I do have to disclose it legally. Let's go straight to the fixed rate. Now the fixed rate is 7.43 today. This is one option. There's a couple options, but this is the lowest option. So I wanted to show that here. Now you can see there's no line of credit. There's still mortgage insurance. We're still based on the same home value. The principal limit is slightly lower, but what's a lot lower is the total available funds. And on a fixed rate, you have to take the funds as a one-time lump sum payment at closing. So again, if you have need for this money right now, and you think a fixed rate is best for your safety, this might be a fit. Where it's not a great fit is if you don't want or need the money now, and we're expecting interest rates to go down, which we are right now. And when I say right now, I'm making this video in June of 2024. So in the fixed rate option, there's no line of credit. There's no monthly payments to you. There's no flexibility. You would have to take this cash as a one-time payment to the bank account of your choosing and figure out what you want to do from there. I just don't see many people choose it because of that. All right, let's go to the amortization schedule. If you need a break, this is a really good time to pause. This is a really important piece though. Keep coming back to this. We're going to go over some details that people are not fully aware of about the reverse mortgage that make a huge difference. All the numbers we saw up in the previous page are all the same here except for one. Let me move my pretty face over here. This is the new number. Expected appreciation, 4%. Now, FHA mandates we must use 4% appreciation on these projections for the expected appreciation of your property value. It is the long-term national average of appreciation. Betty Boop is in Oceanside, California, which is where I live, and I will tell you that Oceanside, California has had much, much higher appreciation than this. So that means all the numbers we're looking at for Betty Boop, it's not true for every market across America, but for Betty Boop, for this, these numbers are conservative, which is good. Everything I like to do is any surprises need to be happy surprises, not bad ones. So we are financing in the closing costs. That is the initial loan balance. So let me move my face back over so I can keep doing this. I'm going to show you how to read this sheet, and then I'm going to go into some what ifs and some examples of what might happen in the future and how to handle it. This column here is years out from today. This column is Betty Boop's age, or the youngest borrower or non-borrowing spouse's age out from today. SVC, servicing fee. Some reverse mortgages have it. This one would not. Lisa, if Betty Boop had any income or credit challenges, she may have to have a Lisa, which would be a portion of that line of credit withheld with the lender, and then the lender will pay her property taxes and insurance for her life expectancy. It's a pretty large amount in most cases, so if you can avoid it, most people do. Some people like it, and I really like when people want the Lisa because the number one default is not paying your taxes and insurance. Some people aren't able to, but then we also have a portion of people who just forget because there's no monthly mortgage payment. They just forget to pay the property taxes and insurance. And so this allows the mortgage lender to pay it for them. So you know you have your whole protected roof over your head, right? Taxes, insurance, no mortgage payment is just a very protective strategy. I do like it when it fits. It doesn't always fit though. Monthly disbursement, had Betty Boop asked for that monthly payment, that would show up here in an annual amount. Mortgage insurance premium, that is that 0.5 annual ongoing amount. It is simply based on the loan amount and it is added to the loan amount unless you pay it, which you can. We're going to get into that next. Interest is the same. The interest is based on the loan amount and it's simply added to the loan amount if not paid. Now, there are some reasons that people may want to make payments towards the reverse mortgage. At this point, I want to explain something I have to wrap your heads around. So a regular mortgage, I think of it as a one-way window. And you make your payment every month into that window. And that window takes your payment, you pull your hand out, and the window closes. You can't reach back in and get that money back out. With a reverse mortgage, you can reach back in and get that money back out. And so, because of that, a great strategy, if people don't want that loan balance to increase, this puts you in control. And this is something most loan officers don't explain, which I wish they would. That's why I coach. This is really important to understand. Some people will treat this like an interest-only loan so that the loan balance does not grow. Now, there's good reason to let the loan balance grow. We're going to see that in a minute, but some people just, for whatever reason, want to do it this way, and that's fine. So what you would do is you would simply make a payment, an annual payment or a monthly payment for these two amounts, the interest plus the mortgage insurance. I'm going to get my old school calculator. Some of you guys might remember these. So 1766, we're going to go 129 plus. All right, so the total annual payment you would make in order to keep this loan balance from growing would be $1,895. Or if you wanted to break this into monthly payments, you would simply mail in a payment for $157.92. That would keep this loan balance from ever growing. Now, the way payments work, it's pretty cool. You can make payments for a year, 2 years, whatever. When you stop, nobody calls, nobody cares. Now, if you make a payment, they will, of course, cash it. It does 3 really cool things. It goes towards this mortgage insurance first. It goes towards the interest. And then if it's big enough, it'll go towards lowering the loan balance. Keep in mind, do not let that loan balance go below $150. Otherwise, they'll close the whole reverse mortgage and you'll lose this line of credit we're about to talk about. So if you do that, if you want to pay this down so you don't have any interest accrued, you can do that, but don't pay it beyond $150. Leave that so it stays open. But if you did that, that would also dollar for dollar increase your line of credit. It is such a cool, versatile thing for retirement, because in retirement, it's all about cash flow, right? You have accumulated all these assets your whole life. And the purpose is so that when you get to retirement, you can live on them. And what bigger asset do most people have other than their home and the equity in it? But traditional financial planners say, oh, don't touch the home's equity. Why? Because they don't get paid on any product that uses the home's equity. So they just say, let's stay away from that. I don't understand it. I don't want to do it. It's too risky for me to talk about it. You need to talk to a certified reverse mortgage professional about this to talk about the home's equity. And it's the licensing thing too, right? I'm a mortgage licensed professional. Financial planners typically are not, so they shouldn't be talking in depth about mortgages. So it increases your line of credit dollar for dollar, which gives you control of your cash flow. Now, that's money you're not using from other assets. So let's say you do have a retirement account. Instead of pulling money from your retirement account, you can pull money from your line of credit. Really, really cool strategies. There's a lot of different strategies I can go over. We're just going to go over this line of credit growth because this is a protective way for Betty Boop to protect her future. Lisa balance. Oh, before I move on, excuse me. The loan balance assumes you never make a single payment. Most people who have a reverse mortgage don't make a single payment because the appreciation makes up for it. And we'll see that in a minute. But this assumes that you never make a single payment, so it continues to increase. The Lisa balance, if there were a Lisa, that would show up here. The line of credit. This is the power. This is why Betty Boop should do a reverse mortgage, even though her home is free and clear. Because it will give her immediate access, right? All she has to do is fill out some forms, send it in. It takes 3 to 5 business days, and they put the money in her bank account. Give her access to her credit, to her home's equity through the line of credit. It starts at $264, but it grows pretty fast because this is a pretty big number. So growth rate of almost 8%. Where is it? I have on the previous page. The growth rate of, it was either 8% or I think it was 8%. The growth rate on this is compounding pretty fast. All this is increased access to her home's equity. This is not interest being accrued. The interest being accrued is on this column, the loan balance. So the line of credit continues to grow. In just 9 years, it doubles. 9 to 10 years, it doubles. In 20 years, it goes to over $1 million. So just because Betty Boop decided to do a reverse mortgage when she was 67, at the age of 88, suddenly she has access to $1 million available to her through her home's equity. Now, why is this so huge? Because people are living longer than ever. Medical costs are just painfully astronomical. In-home care costs. Most people don't have long-term care. Some people do. I just did a reverse mortgage for a lady who had long-term care, but it wasn't paying for all 7 days of the week care, and she needed all 7 days of the week care. It was paying for 5 days. So the reverse mortgage came in and paid for the remaining days, in which case, if Betty Boop, even if she had long-term care, she may be in that situation. But let's face it, most people don't have it. And one of the drawbacks for long-term care some people will complain about is the money can only be used for that. This money can be used for whatever you may need. Say you are Betty Boop is a happy, healthy, active 88-year-old, and she wants to now go on cruises. She wants to go salsa dance in Morocco. Do you salsa dance in Morocco? I don't know. That might not be an app. Anyways, she can use this money for anything. Maybe she wants to put a grandkid through college. Maybe she needs a new car. Who knows? Maybe the house needs a new roof. In 20 years, that's a realistic expectation. She can use this money for anything. And if she did need it for long-term care, one of the cool things about this is at that point in time, she can call the company and say, hey, I have this line of credit. I need monthly income now to pay for, she doesn't have to explain anything, but an example here, she can say, monthly payment on my long-term care is $8,000 a month. Can I do payments to me in equal amounts for the rest of my life instead of this line of credit? And for a $20 fee, they will switch it to monthly payments. Now, I can't predict what that number would be right now, but at that point in time, they would tell her, okay, $1 million in your line of credit can be translated into this much monthly amount for the rest of your life. Do you want to do it? And she could do that. And so that's a really, really protective strategy. The other thing is that rarely anybody, unless they die pretty young, gets through retirement without big life events. Big life events in the form of a fall. 1 in 4 people will fall. Big life events live too long. You know, the biggest fear is outliving your money. This protects you against that fear. You're not going to outlive your money if you do this, and you do it wisely. Don't blow through all your equity in the first 2 years, please. Let it grow. Let it sit there. This is such a beautiful strategy. Now, I want to point something out. When you get a reverse mortgage quote, they always end at year 100, which creates the misconception that the reverse mortgage ends at year 100. Some people think they have to pay it all back at year 30. That's not true. It's also not true that year 100 is something significant. It's just the arbitrary marker where these numbers stop on our projections. The reverse mortgage itself will not. The way the note reads is the lender has the right to reassess the reverse mortgage 50 years beyond the youngest borrower's 100th birthday. So you'd have to get to 150 years old for them to do anything different. And right now, I think the oldest person in recorded history was 112. So it's not happened yet. Cool fun fact, the oldest person to get a reverse mortgage was 103. So you can get one of these at whatever age too. Now imagine if she did live that long. Oh my gosh, this line of credit is gigantic. Now the cost of living and inflation will probably make that not seem so big at that point in time, but still, that's a really nice lump to be able to pull from. And now the next question, but Christina, am I robbing my heirs? Nope. Let's take a look at that. So the property value appreciating at just 4%. Likely in Oceanside, California, she'll experience better appreciation than this, which is cool because the equity is so big already. That just means it would be that much bigger. So the property value is appreciating 4%. You can see that just increases. And that's on average, right? Long-term average. We get to the equity column by taking the property value, subtracting out the loan balance, and that gives us remaining equity. So as I said, you are still the owner on title. You can sell at any point. This equity is yours, or it is your heirs. So really important to still set up your, I like trusts, I really do. I think trusts are a really protective way, but still set up your heirs to inherit the property and let them know there's likely going to be equity. Don't just mail the keys in, get that equity out. By selling the home, heirs are going to have a couple of other options. So the equity, as you can see, just continues to increase, even with never making a payment. Now, that's because this loan balance is low. If in year 11, Betty Boop borrowed all $590, then that would turn into loan balance, and that would decrease the equity. But even in those situations, the equity is still pretty significant, again, because you can't borrow. Look, the home value is 1.2. So she would still have nearly half of the home's value in equity at that point if she did do that. Big misconception. I want to make sure you understand that's not how it works. In fact, let's see, does it even turn around? No. Some projections will turn around, especially if your main goal for the reverse mortgage is to pay off a big mortgage and you're using like all the funds to do that. Sometimes those numbers do turn around where equity will grow for a certain number of years, and then it'll start to slowly decrease over time. But in this situation, it doesn't. Equity continues to grow right off the page. Let's go into an example. When I talked to Betty Boop, she said, I do want to live in this home for the rest of my life, but unfortunately, some people are not going to be able to. So it's important you're working with a loan officer who understands that and is protective of what you need now, what you may need through retirement, right, that line of credit, and what is going to happen at the end. Because for a certain percentage of people, they will have to sell their home to get that equity out and pay for a higher cost of care, like a nursing home or wherever they're going. Typically, people are looking to sell the home, pull the remaining equity, and pay for where they're going. And so in that case, That's another reason I like the FHA HECM for the lower interest rates, because that allows us to have even more equity long term. So if Betty Boop were to sell at this point in time, let's scroll so you can see the titles. The property value is predicted to be 1.1. She would simply pay off the mortgage. She would sell for 1.1, pay off the loan balance of $51,000, and walk away with remaining equity of 1.132. This number includes the line of credit. Remember, the line of credit is just access to a portion of that equity. So what this is saying is, of the 1.132 in equity, she can access 548,000 of it. But if she doesn't, when she sells, it's just included in that equity number. So she would choose the realtor of her choosing, sell the home, pay off the mortgage, and get the proceeds of 1.32 less any cost of sale or realtor fees. Now, this situation is the same for what heirs may face if they were to inherit the home at this time. Heirs are going to have a couple of other options, though. Heirs can also keep the home, and in this case, they may want to turn it into a rental or something, maybe live in it themselves. Who knows? They can keep the home just like any other mortgage. The mortgage needs to be paid off. They cannot assume the mortgage. Reverse mortgages are not assumable. The borrower is the borrower. And once they have passed or move out of the home permanently or sell, the mortgage needs to be paid off. Now, if they were to do that, they could keep this by paying off this loan balance in cash or refinancing it into another mortgage in the heirs' names. So, for those of you who do want to pass the actual physical home to an heir, and the heir wants, or heirs in general, just know that they're going to have to qualify or pay this off. Now, some of you are going to have life insurance, and so other estate assets can provide for that. Some of you are not. Some of those heirs are going to have to qualify for a mortgage to pay this off. So keep that in mind. All right, now let's go into the hypothetical. People say, what's the worst that can happen? And I don't think it's the worst thing that can happen, because in the hypothetical I'm about to say, you are being forgiven a big amount of debt because of that mortgage insurance you're paying for. Let's go into it. Let's say Betty Boop does live to be 110. And let's say she borrows this whole line of credit. So now the mortgage balance is like $3 million. And the property value is predicted to be right around there, maybe a little higher. But let's say she passes away during a market crash. So we've got a $3 million mortgage, and the market has crashed and her home's only worth $2.5 million. Who picks up the difference? Are the heirs going to have to pay the difference, that $500,000 difference between the mortgage balance and the home's value? No, the FHA insurance that you are paying for protects them. They can literally mail the keys in. They can still sell the home and pay back whatever they get for it. And or heirs can pay back the reverse mortgage company 95% of the home's value and keep the home. And in that case, they are being forgiven that $500,000, or not really forgiven. The insurance is picking that up. So this is a really protective way. They're not going to affect any other assets. So if you're leaving other retirement accounts, it's not going to be looked at even in that situation. Such a protective strategy. Now let's go into the costs. People always want to ask about the APR. In reverse mortgage, we have the total annual loan cost rate, a number you'll never see on any other kind of mortgage. Okay. What the important piece to discuss here is the reason we talk about APR or talc is because we're trying to compare, okay, we have these closing costs. Does it make sense? What I tell people is if you're keeping the reverse mortgage for less than 2 years, don't do it. Generally, there's like one situation where maybe it might make sense. But in general, it's an expensive way to get through the next 2 years to get access to your equity. There's other kinds of mortgages, unless you can't qualify. And very rare situation for that. Typically, you want to get a reverse mortgage if you're going to keep the home more than 2 to 5 years, somewhere in that range. I say, okay, reverse mortgage can be a good fit. Now, what we're seeing here is the explanation of that. So accounting for the $25,000 it takes to put this thing in place, whether appreciation is 0%, 4%, or 8%, it kind of doesn't make that much sense to do a reverse mortgage if you're only going to keep the loan for 2 years, because your cost of funds, your total annual loan cost rate, has been 18%, accounting for those initial upfront costs. You want to have a longer period of time to weigh out those initial upfront costs. Now, Christina, what if I keep the loan closer to 9 years? Well, that brings the rate down quite a bit, 10.29. To be able to have that giant line of credit available to you. That makes sense. What about 17 years? Ooh, the number just keeps coming down. 9.27. What about 24 years? Well, assuming appreciation, right? We're looking at an oceanside California property, so there will probably be appreciation of at least 4%. The cost of funds has been 8.93. Now, why is this the only column, the only category to have a lower number? Well, because if in 24 years the property is still worth $800,000, which really far-fetched, but if it were, then you are using that non-recourse provision, and the mortgage insurance is forgiving some of the debt or picking up the difference. And so you have an even lower cost of funds. And so people say, oh, that's worst case scenario. And I'm like, is it? You are getting a really good cost of funds, and the rest of your assets can still go to your heirs. It's just a really protective strategy. So that is what I want to discuss today. We are at about an hour, which is a long video, so thank you for sticking with me. If you'd like to look at your reverse mortgage numbers or someone that you love or care about, in the comments, you can link to my webpage and contact me directly. If you are a loan officer looking for coaching, this is a great start. This is just one strategy. There are so many more strategies, and there's a lot of things you need to understand. If I had laid out a different strategy or different structure, there'd be different things we need to go over. So please contact me. I have various coaching programs. I run various masterminds for loan officers to learn this stuff. Thank you for sticking with me, and don't forget to subscribe and like. It's free, and it helps me continue to produce more content like this.